casts a wider net for people who are able to invest. There's no minimum investment typically, unless the operator or the offering stipulates that there is. And so we stipulated a $10,000 minimum offering. And we came to this because in the apartment space, in the multifamily space, there's a lot of syndicators, and the minimum investment is 25 to 50. They ended up going to 100 on some offerings. And we felt like it wasn't giving the opportunity for smaller investors to invest and learn and understand the process of what it's like to invest alongside other people to get the benefit of their capital being put to work without having to do the work themselves. And that's why I like the crowdfund system. You don't have to be accredited, and meaning you don't have to have a high net worth. You don't have to be earning excessive amounts of money. You can still invest in these deals and understand real estate and get to learn real estate and work with an operator like myself who has a ton of experience without having to go out and source the deal yourself, swing the hammer, and try to buy and sell property over and over again. You get the benefit of somebody like me doing that.
Right.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Welcome to another amazing episode of Raising Private Money. I'm Jay Conner, your host, also known as the Private Money Authority, and I'm so excited to have my guest on today's show because he is an expert in crowdfunding. We're going to talk about crowdfunding, what it is, how to use it to raise capital. We're also going to talk about why my guest chose crowdfunding as his preferred platform to raise capital. He's got a lot of experience. He has overseen over 500 transactions. Now, he started going into multifamily back into 2020, but there's a reason that he chose to back off from multifamily and actually stay in single family houses, which of course is my preferred investing vehicle anyway. He's raised over at least $5 million in private money, so he's very qualified to talk about private money. And his crystal ball, what does his crystal ball say? Well, we're going to see what he thinks is on the horizon, right around the corner and coming up in the next year. In just a moment, you're going to meet my special guest, Randal McLeaird, right after this. Well, hello, Randal, and welcome to the show.
Jay, great to see you. I am happy to be here. I know you have a ton of great guests on your show, so I'm honored to be part of that.
And, yes, you're in the 800s, Randal. We got quite a few hundred episodes here on Raising Private Money. Started the show about 8 years ago, and we're glad to have you on. And I'm so excited to talk with you today about your expertise, one of your expertises, and that being crowdfunding. But before we get into it, I just want to remind everybody, this is the show, this is the podcast where we talk about raising private money without ever having to ask for money. At least that's the way I go about it. And so we're going to have fun talking about private money and crowdfunding. Before we get into that, though, Randal, tell us your background and how it is and what you went through to get to where you are today.
All right. Well, again, thanks for having me on, Jay. It's an honor to be here again. I just looked down at my notepad and I have a bunch of notes from when you were on my show just a couple of days ago. And so, again, I was looking through and like, oh, I got to do this and do that. So again, thanks for jumping on my show. How I got started was in 2004, I graduated college. A buddy of mine who I went to high school with, he had already been out of school or never went to college, had the same exact birthday as me. And I ended up going and getting a job for him, working for him right out of college. And it kind of clued me into a few things about schooling and about all kinds of different things. But one of the things that I got out of it was real estate. And that was because he had his own mortgage company and he had toys. He had, multiple condos. He had all kinds of stuff. And it was out in Myrtle Beach, South Carolina. And it was an eye-opening experience for me going to work for somebody who hadn't gone to college, right? After just finishing my 4-year degree. So that's really the start. I was doing loans, doing mortgages, the ninja loans for everybody back then. So I saw a lot of transactions back in that time frame. Went and lived overseas for 3 years. I was in Australia, living there, running some company, doing some things, and having a good time over there. But I always wanted to get into real estate. And so in 2008, I came back to the United States and was trying to decide. It was a pretty tough time to be getting into real estate in the United States, arguably from somebody who hadn't been doing it. But it turned out to be the best time to get back, obviously. And so when I got back, I was trying to decide, the market's not so great right now. Should I go back to law school, get a law degree? And so I went to a few RIA meetups, met a real estate attorney, and ended up talking to him and said, hey, can I come work for you for a little while, just because I want to learn the law side of real estate and understand if that's something that I actually want to be involved in or not. And went and took some classes at the local university as well, just to, again, see if I wanted to get back into the university system and go back and get a law degree. But anyway, in the process of working for this attorney, I was going out, seeing a ton of houses, looking at a bunch of properties, because he was a real estate attorney. And so he gave me his access to the MLS, and I got out to see all these properties. Ended up getting a deal because I was his closer. I was a fee attorney closer. And I got a deal from another investor who came. I was doing the closing for him, and he ended up backing out of that deal at the closing table. Actually just called in and said, hey, I can't close this deal. I'm my money's set up on something else. The seller was already there sitting at the table. And I was looking at her. He had it under contract for $15,000. I think I had like 12,000 to my name at the time. And I said, look, I got 10 grand. Do you want it? I'll give it to you right now. And so we changed the docs. The attorney changed everything around. I bought it sight unseen. I'd never seen this house. And that was the first deal that I ever bought in San Antonio. That same seller later sold me the lot across the street, and that lot I bought for $1,000 and ended up owner financing that lot with $1,000 down, and then I had a note for $2,000. And so that's really the start of my owner financing strategy that carries me through today. I created a bunch of notes back in the day, still have some of those, but that was really the start. That was 2009, give or take, whenever I first started buying properties here in San Antonio.
Are you glad you bought that $10,000 house? For sure.
It scared me when I first drove up to that property. At the time, I tell the story. It's just funny. I was in a tiny little Suzuki white little car, like me, little guy driving to this property. Didn't really know anything about the east side of San Antonio at the time. And when I'm pulling up to the property, the entrance of the neighborhood was bail bonds, and like all these burnt down houses, and all these guys were just kind of sitting on the stoops, just looking around, nothing to do. It was 2008, 2009. A lot of people had just torched their houses in order to try to stop making the mortgage payments on them. So I thought I bought a foundation. Luckily there was a house there, but when I opened the door, there was a massive hole in the ceiling. I was like, all right, I know how to fix this. Luckily I can swing a hammer and do my thing. So anyway, I ended up just flipping that. I paid 10 for it, and I sold the paper. Didn't do any work or anything. I sold it for $15,000. I was like, okay, it works. Let's go.
So what's the summary of the past 14 years since you bought that house?
So we ramped up. I mean, I was buying and creating notes, and I've done transactions just like that over and over and over again. So we at one point we're doing 50 transactions a year and flipping houses, wholesaling houses, buying dirt, selling dirt, rezoning properties, getting properties entitled, and then got into I heard your intro, got into the multifamily space, and the ramp up from 18 to 23 in the multifamily space. I mean, properties were just going gangbusters in pricing. And so I didn't actually buy anything myself. I partnered with some people, bought some things in those deals. I'm happy to talk about them, but they have not performed as well as any of my single family or any of my other investments that I'm in full control of. And so that's what got me to say, look, I'm just gonna keep working on this single family side of things right now.
So in the single family house business, are you flipping? Are you wholesaling? Are you holding? Or all the above? What you doing?
Yeah, all the above. Mostly flips right now, just because anything that I hold is going to be a note. The process, again, when you're going direct to seller and you have a full machine that you're going and spending all this money. I mean, you and I literally talked about this, and you gave me some information and some help on, look, if you want to go direct, here's a few better sources that you can use. And so again, I appreciate that. But I changed my whole business model from having acquisitions, lead management, acquisitions, and then everything in-house to where it's literally, I can just look on a few websites, talk to the wholesaler directly, buy direct from them, and then I can send my crew out there and they can flip it. So that's been the process the last couple of years, just because it's relatively low maintenance on my end. Doesn't take a ton of time out of my day to manage that process. And I have the capital so that I can go do that. Does that answer your question?
Yeah. So you just mentioned the word capital. And so since this is the show titled Raising Private Money, let's talk about raising capital. So you got experience, expertise in crowdfunding. That word crowdfunding is sort of a misnomer. You hear it, it's sort of a buzzword out there, but people have different definitions of what is crowdfunding, how you go about raising capital when you're doing crowd. So give us your definition, Randal. What is crowdfunding?
Well, the way that we are using it is to raise money from people that we may or may not know, which is the reason crowdfunding exists. You can put it onto a platform. So you have to have your capital raised through a platform, kind of like Invone is who we use. Your offering is listed there, and then anybody, whether they know you or not, they can actually invest in your deals. And we used that because it casts a wider net for people who are able to invest. There's no minimum investment typically, unless the operator or the offering stipulates that there is. And so we stipulated a $10,000 minimum offering. And we came to this because in the apartment space and the multifamily space, there's a lot of syndicators, and the minimum investment is 25 to 50. They ended up going to 100 on some offerings. And we felt like it wasn't giving the opportunity for smaller investors to invest and learn and understand the process of what it's like to invest alongside other people to get the benefit of their capital being put to work without having to do the work themselves. And that's why I like the crowdfund system. You don't have to be accredited, and meaning you don't have to have a high net worth. You don't have to be earning excessive amounts of money. You can still invest in these deals and understand real estate and get to learn real estate and work with an operator like myself who has a ton of experience without having to go out and source the deal yourself, swing the hammer, and try to buy and sell property over and over again. You get the benefit of somebody like me doing that.
Right. As with pretty much any private lending opportunity, it's a great way to be passively involved in real estate. I've got 47 private lenders right now, individuals, and everything we do is what's called a one-off, meaning we have a single family house, and then we may have a private lender or maybe a couple of private lenders that are, that are funding that deal. So you mentioned a platform a couple of minutes ago that you use, I guess it's on the internet, for your crowdfunding raise. What was the name of that platform and how does it work?
Invone, Invon. Levy Brackman and his team put that together. Levy's a great guy. So yeah, certainly on my podcast, I think it's 154, episode 154. I go through and talk to him in depth about his platform and what it is. So basically, as you mentioned, it's a one-off what you are doing. So traditionally in single family, you can go and borrow money from an individual, or they can lend you money and be the first lien on that property, and they're on that deal. What a crowdfund is, it's more like a fund where you can buy multiple assets with the capital that you have raised, deploy that capital, and it's at work. And so the investor is in the deal for 3 to 5 years, and then we exit all of those notes and sell them out. So on your deal, you might set them up to where they're your private lender is involved for 5 years, 10 years, or 6 months, depends on the strategy that you're implementing and using. For ours, we're creating, and we're either creating notes, so we're selling homes on owner finance, and our fund is actually the one that is owning that property. And so I can walk through. I'll break down the whole how we do it and like how you get paid back. But the major difference is with a crowdfund, you are along for the ride, and you have a lot of different assets that your capital is being used to purchase, rather than a one-off where it's like your money is for 123 Main Street only, if that makes sense.
Right, right. So they invest in your fund, and the money that you use in the fund is used on multiple projects.
Correct.
Right. So when a private lender invests in the fund, since their money is being used across, different properties, different assets, then there's not like a note, like they're investing in the fund. There's not a mortgage, there's not a deed of trust. So is the way you do crowdfunding, is it regulated by the SEC?
It is. Yeah.
Right. So how does that work? What do you have to do with the SEC for crowdfunding?
We had to file a Form C with the SEC. Again, you can't raise capital through Regulation CF on your own. You have to have a platform that hosts it, and that's where Invone comes into play. And so if you go to their website, Invone, you can invest in like bourbon barrel investing, which was some wild investment. You can invest in a startup company that may be working on X, Y, and Z. So traditionally, crowdfunding has been used in the startup space. Hey, I have a widget. I want to sell this widget, but I need, $100,000 in order to get it off the ground and launch it. And I need to raise money from, everybody that wants to donate $5, right? That's traditionally how many people have used crowdfunding. It turned into a real estate opportunity because there is a minimum or maximum annual raise of $5 million. And so what people had started doing on the multifamily space, they would go out and they would do a 506C raise, which is accredited investors only, but you can advertise, you can market for a large portion of the capital stack that was required to buy a $20-40 million property. But then in order to open it up to other investors who were maybe smaller investors who were non-accredited, they would couple it with a CF raise, and you could raise up to $5 million from smaller investors. And so, taking it for the use that we have, which is we want to raise $5 million. We want to deploy that into 25 to 30 properties, and we're going to create notes around those. It's a great vehicle for what we are trying to use it for, just because we don't need to raise more than 5 million on any given year to be able to buy the number of properties that we want to buy.
That makes sense. So comparing and contrasting your crowdfunding opportunity, why are your investors, why do they like it? Why do they get interested? Why do they decide to invest in your crowdfunding opportunity, say perhaps other than something else?
Well, I mean, if you compare it to a CD, or if you compare it to a traditional 401k return profile, we're offering a 7% return on a $10,000 investment. I mean, there's not many opportunities like that, and it's a quarterly payout, and it starts the day your capital is deployed. It's like a loan, but it's like an interest-only loan. Your principal is not getting paid down, so you're going to earn that every year that you have that money deployed. And so when you look at being in a first lien position where you're getting your principal interest your principal and interest payments, you're getting your principal balance reduced over time. And if you're the lender, you're the investor in that deal, then you have to deploy that capital somewhere else again. So your money's not necessarily always at work in any given year. So if I have $100,000 to invest and I put it towards a deal, if it gets paid back in 6 months and then it sits there idle for another 4 months, then it gets deployed. And that's a total of 6 months that it was deployed in any given year. And so I'm not earning a true, 10% or whatever that number is. And so for us in this scenario, it is, okay, we have your capital, it's deployed. We have 123 Main Street plus 15 other properties that your money's being used to purchase. Those houses are paying us a mortgage every single month, and you're getting your interest every single month or every single quarter until we sell the entire package of notes.
So it's like an individual putting money in a certificate of deposit in the local bank, except they're making a lot more money. Instead of
Correct.
3%, 4%, whatever it is, they're making 7%.
Yeah.
So when you put this opportunity out there on the platform, and by the way, I'm sure we've got a lot of listeners to this episode that are interested in learning more about how to get involved, how to get these high rates of return. So in case anybody's got to jump off early, I want you to go ahead and share right now, Randal, how people can learn more about your crowdfunding opportunity. And I think you've got a new project coming up that you're doing a raise for as well, right?
We currently have the crowdfund open. Yeah, it's if you go to www.ridgelineig.com, yeah, it's right there on the screen. On the offerings tab, there's the RAM Capital Fund, and you can go straight through and read about the investment opportunity. And yes, we are raising for that right now. We just closed one of our first properties in that fund, and to run through how that works and how this whole thing works. We buy property. So I bought this property for, I think, $105,000. We're going to put 20,000 into it. So we'll be in it for 125, and we're going to sell the property for right at 200, 215. So we should have a note to our end buyer for 200. And we only invested $130,000 in this deal. And so that spread, we're charging 8 to 10% interest to our end buyer, and we're paying out up to 10% interest to our investors. And so we're collecting the delta, the spread in between. You collect your money throughout the whole hold process. And then when we sell and exit, you get your return of capital plus all the cash flow that you received throughout the hold period. So that's the mechanism, and that's the strategy, and that's how well protected the capital is in that deal. Because if we're in the property for only $135,000 and it's worth $200,000 on the note, that's a huge delta that we've got for any fluctuation. Should we have to foreclose, take the property back, or do anything like that? So again, that's the mechanism for how the payments are made. And to clarify, I just said 10%. So if you invest the minimum of $10,000 up to $25,000, you get a 7% return on your money annualized, right? That's annual return. If you invest up to $150,000 or more, then anything above $150,000 is a 10% return on your money. So it's just like, again, a CD. If you invest more, then you get a certain type of return. So the properties that we buy, most of them hover in the 125 to 150 range. And so a single investor could be putting their capital to work immediately on an individual property that we buy and earning up to 10% on their money annually on an interest-only style. It's not a loan, it's an investment, but you can think of it as a loan.
Again, that website to learn more about Randal's opportunity for you to invest in is www.ridgelineig.com. That's spelled www.ridgelineig.com. And Randal, where are your properties that your company is investing in?
Everything will be in San Antonio, Texas.
Okay, so right there in your market. And so all the properties are there that you can drive by, your team can drive by. You don't need boots on the ground in another state. It's all right there where you can keep your eye on it.
Correct. Yeah, it's where we've been buying for the last 14 years. Yeah.
Right. Well, you know the market like the back of your hand. So about how many properties have you got going right now simultaneously out there?
Yeah. Right now, we've got probably 5 going right now.
Okay, cool.
Yeah. Some in the wrap up stage, and some are finally getting listed, and some, permits getting approved, that sort of thing.
Sure. And again, you are now doing a capital raise for a new raise that you've got going on. So again, if you're listening to this show, you definitely want to check out that opportunity there with Randal at ridgelineig.com. So other than people listening to my podcast, Randal, how do people hear about this opportunity? How do they get to your website? How do they find out about it?
How am I marketing currently? Is that the question? So multiple different ways. They're going to local meetups. That's one. Reaching out to my contacts who have lent me money in the past. That's another. And just having the conversation on podcasts just like this. I mean, I'm out talking about it. We had created the fund, and it took a minute to get it up and running. And so now that it's up and running, I'm out doing the podcast circuit, talking to guys like you and reaching out to your amazing audience and talking to people who are looking for a great opportunity to invest alongside somebody like me.
I assume when you said it took a minute to get it done, you're using the new definition of a minute and not the old definition of a minute.
Yes, it was not a minute. It was first time trying it and doing it. It was, and that's why Levy, again, his team, I can't plug them enough. They stuck with us and helped us through, a million questions that we had about how this works, how to do this, how to do that, their contacts, their attorneys, and everybody else on their team. Solid guys.
Right. Well, it is fascinating. So I think I know the answer to this question, but I'm going to ask it anyway. Why did you choose crowdfunding versus one-offs? A private lender, a couple of private lenders, funding a single family house.
Again, doing this over a long period of time, if I could do the paperwork once, which is what we did, setting up a crowdfund, and be able to raise the capital once, then that is the ideal scenario. It's just one of those things where when you have to go back constantly and ask for capital, you do it all the time. So you could answer that better than I do, but it is always turns into a reselling or a new conversation about why this one property makes the most sense. I feel like my track record speaks for itself when I've gone and done hundreds of transactions, right? And so if the first deal out of the 25 properties we're going to buy is the same as the 25th property, then going and asking for the capital over and over again, it just seems like it's an added level of work that doesn't necessarily need to happen. If the investors are happy, everybody's getting their interest getting paid, then again, if we can do it once and raise the capital and be able to go out and deploy that capital, then that's one reason. The other reason is, again, once you have invested, then your money is at work. Your money is not sitting idle for 6 months of the year. It's always going to be earning interest throughout that entire year or throughout the hold period that we've got. And again, to reiterate on this, it's a 3 to 5 year hold. If you want to get out, you can get out. We just have to replace your capital with some other capital. So those are the two main reasons why.
Yeah. Well, and the third reason I was thinking of, like, my minimum that I have that a private lender, an individual can get involved with my opportunities is $50,000. And that's not because I'm going to use $50,000 to purchase a property. I can use $50,000 for rehabbing and renovating a property, but not purchase. But with your opportunity, someone can start as small as $10,000. So that just opens up a whole nother world to you with a lot of other investors that would like, or not able to start, with much more than 10,000 or so.
Yeah. Or just want to try it. It's one of those things. There are deals that I have invested in with operators, and, I said, look, I just want to test you out. Let's check it out, see how it is. And then, over time they prove themselves, they show themselves, and I invest more money. So it solves both of those things.
Perfect. Well, Randal, we're about ready to wrap up this episode. Anything else that you would like to share with the audience about Ridgeline IG or anything else?
I mean, we're excited for 2025 and looking forward to the new year that's coming up. Again, raising the money right now. We're deep into that, and we're sourcing properties right now, and looking forward to, deploying and buying 25 properties this next year and having the fund fully deployed and up and running and paying out solid returns.
Well, before I let you go, what does your crystal ball say the upcoming year? What do you see?
I was wondering if you're going to ask, because, I asked you on mine. Again, on the single family front in San Antonio, Texas, I feel like the market is strong. I've been buying through a heavy down cycle in 2008-9. And back then we were buying properties for $20,000, $10,000. It's not that right now, but there are deals to be had. There are a lot of investors who have slowed down or gotten out of the market, and that leaves more opportunity for guys like me who are still buying to go out and buy more properties at better deals and at lower prices. So I'm excited for the local market that we're in. As far as, the entire nation goes, like not gonna sit here and rub the crystal ball too hard and give you any kind of detailed report, because I just don't think that it'd be worth the 2 seconds it would take for me to explain it, but in San Antonio, it's looking good. I'm excited for San Antonio in 2025.
I did read just this morning, an article came out this morning, and they had surveyed, I can't remember how many people they surveyed. It was quite a few. But anyway, over 70% of Americans believe, they could be wrong, believe that the upcoming year mortgage rates are going to come down. We're going to see mortgage rates coming down. I'm in the over 70%. I believe we're going to see mortgage rates coming down, particularly with, the new administration that's coming in January. But anyway, that's my crystal ball for this show.
Again, if Elon gets in, don't bet against Elon. He's I feel like the Doge is gonna bring a lot of positive to everything. So yeah.
By the way, has anybody ever told you look like Elon?
No, I have not gotten that. No, I have not.
You're a younger version of Elon.
That's a compliment. So yeah, no, but I'll put that on my Facebook page now. Jay said.
That's right. Jay Conner said.
Yeah.
Oh, mercy. Randal, thank you so much for joining me here on Raising Private Money.
Jay, appreciate you having me on. Have a great day.
All right. God bless you, my friend. Well, there you have it. Another amazing episode of Raising Private Money. I'm Jay Conner, your host. Thank you so much for joining us. And I really appreciate you rating and reviewing the show. That way I can keep having more amazing guests like Randal that you just saw and heard from. I look forward to seeing you right here on the next episode of Raising Private Money with Jay Conner.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconner.com/moneyguide. That's jconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.